Hey Wizard! So with over 5 years of working together to analyze the crypto markets, we have to take a step back and say what actually has worked, what has worked consistently. Now, as a developer, by far, the most promising emails I've received on the products that we use for analyzing trading are that of statistical arbitrage for pairs trading. Now that's a big mouthful. So what I wanted to do in this video is revisit statistical arbitrage, because right now I think it's the most overlooked trading strategy in ever and in crypto. And you can tell I'm very passionate about it. And so I wanted to go through it right from the beginning, because I'm receiving emails from folk as well to say, hey, can you explain this? Can you explain what that means? A lot of folk who are new. And I just wanted to bring things back to basics in a way that anyone can understand them, to know what are the metrics and what are the benefits and what is essentially the edge that we can get by having all of this at our fingertips. And so that's what I'm going to do now. We're going to go through these charts together and some of the numbers and the theory. Once you're aware of a strategy like this, it's hard to unsee it. Now, with that said, I am doing this video as a developer. I do not trade full-time for a living, but I do work with traders and I do communicate with traders who use these tools. So please do your own research, take everything I say as a point of view and education, and from there, let's go and analyze pairs trading with statistical arbitrage. So the first thing I want to do is take a look at this chart here, which is Aave and US dollar tether. Now, please just take a look at the chart and look at the pattern of this chart right now. And this is not about chart patterns. I'm not big on TA. I'm not a big fan of technical analysis, but just look at how this coin moves, essentially this crypto moves. Now let's have a look at QNT. If I look at Quant or QNT, you can see it moves in a very similar way to Aave. Now, this pair of Quant and Aave are known as what is a co-integrated pair. And there is a calculation that gets performed to find out mathematically if these two coins have some kind of relationship with each other. And this pair certainly does at the point of recording this video. Now that can change in the future, but right now, as I'm recording this, this holds true. And that's not a subjective opinion. This is objective mathematics. These two coins have a relationship, and you can see how they move together here. Now, what if we could trade the gap between these two assets? What if we could go short on one asset and long on the other and make a profit from that? Well, we can. We can do exactly that. We could go short on QNT here, for example, and long on Aave. And you can see Aave kind of trades sideways and QNT actually takes a drop here. So net, I make profit. And this is actually a form of arbitrage. But it's not as simple as that. It's not just a case of looking at a chart and going, right, this one looks like it's gone up and the other one sideways, I'm going to trade it, because this is all relative to my starting point. Here near November the 15th, if you look at the timeline on the chart, that's where this time frame has started from. So step one, what we want to know is this pair co-integrated? I'll go more into that later in this presentation, but it is. Step two is, when do we actually go and trade this gap? And that's where things get really, really interesting, because if you think about it, if I'm going long on one pair and short on the other, I'm not really trading these assets. What I'm trading is the difference between them. And that difference between these two assets is known as the spread. And the spread you can calculate as follows. You take like QNT in this example, and from that you subtract the hedge ratio multiplied by the price of the other asset, in this case Aave. So what the heck is the hedge ratio? Because by now you're probably thinking, okay, spread, hedge ratio, what are all these, what is all this terminology? But I'm going to bring it to you in simplistic terms. Just know that when you're looking at pairs trading, the spread is an enormously important part of deciding what, when, and how to make a profit and trade these assets. Now, to calculate the hedge ratio, I will come up with a more simple example for you using Bitcoin and Ethereum, because those are prices hopefully you're very familiar with. Let's say the price of Bitcoin is 17,786, which it is at the time of recording this video, and Ethereum's price is 1321, so $1,321. Now, if I take Bitcoin, which is asset number one, and divide it by Ethereum, I get 13.46, which is roughly the same as the hedge ratio that was calculated mathematically. So the hedge ratio you can think of as To own 1 Bitcoin's worth of Ethereum, how much Ethereum would I need to go and buy? Well, I'd need to go and buy 13.46 Ethereum, or in this case, 13.62. There are different ways of calculating the hedge ratio, and I do use a statistical method for this using Python. But for now, if you just need to do this broad brush, you can just take one price and divide it by the other, and you come up with this hedge ratio. Now let's go back to QNT and Aave because it's exactly the same thing, but I just wanted to use prices you were familiar with. So if I take the price of QNT and subtract it from, let's call it the price of Aave, which has now been normalized to match that of QNT, I get the true difference between the two. Now you'll see this blue line crosses that 0 mark on the y-axis. And when I'm looking at that, by the way, it's the axis closest to the blue line. There's a reason I have 2 axes on this chart. You'll see that in a second why that is. But you'll see it goes up like a sine wave, down, up, down, up, down. And essentially what it's doing is it's crossing the 0 line. So what I'm wanting to do is I'm wanting to go and buy here and sell here. So I want to go long on the pair and then short on the pair, or short on the pair and long on the pair. What does that mean? Well, let's say the spread is very low. In this case, I would go long on QNT and short on Aave. And when the spread is very high, I would go short on QNT and long on Aave. So I could decide to adopt that strategy. But how do you decide what the optimum strategy is for trading the spread? When do you get in and when do you get out? Well, again, we don't use guesswork for this. We use something called the Z-score. Some people will put Bollinger Bands on the spread, for example, and trade it like they would any other price. But Z-score for me is the most popular and also the one that I find the most useful, and it works really well in back tests as well. And to use the Z-score or to calculate it, what we do is we take whatever the spread is minus its average, and that average could be taken over any period. We call that the window. It could be taken over a 21-day period or 21-hour period, depending on whether you're analyzing hourly or daily. In this case, we're actually looking at hourly. And then you divide that by the standard deviation. And so if you get wild swings in the Z-score, and the Z-score now we're looking at the left part of the y-axis, it's a lot like an elastic band being stretched. That elastic band wants to snap back. And when I say wants to, I'm using this language very loosely. This is a co-integrated pair. And what that means is that there's a relationship between how the difference of these two assets works, or how it crosses that 0 line in terms of the spread. So these assets, they kind of cross each other a lot. This is, again, in very loose terms, a good way to explain it. And so when you look at the Z-score overlaid with the spread, it looks like this, right? So the Z-score is now in green, the spread is in blue. And for example, what you would do is set a trigger point or any rule for trading that you want to. So let's say I want to go long on the spread when the Z-score is at -2, and short on the spread when it's at +2. And if you do something like that, your trades look a lot like this. Now remember, the spread is the price you're getting, not the Z-score. The Z-score is just an indicator. So the arrows are marked closely to the spread so you can see where we're going long and where we're going short. And so of course here, when the Z-score is very low, you can see we're going long, then we're selling, long, then we're selling. There's 1 or 2 points of this chart. I can certainly see one where you'd make a loss, but in general, your win rate is extremely high. You can see that statistically, this has worked very, very well over time. And if you were to plot this in terms of profitability, or what we look at called the equity curve, which basically looks at what would your returns have been. If I assume returns of 1, meaning I've got the same amount of capital I started with, well, actually, this strategy would have ended up making about a 50% return, ignoring all costs, right? Ignoring all trading commissions, just to look at a pure strategy from a pure strategy perspective. Now, how is that? So the green line is the net position. The green line shows you, based on my longs and my shorts, how did I do? The blue line represents how QNT did in terms of the returns it gave you from the trades you placed using that. And Aave is obviously then the other one. And the green represents, again, the net between the two. So the idea with statistical arbitrage is you'll probably lose on one part of the trade, but you make more on the other part of the trade than how much you lost on the other asset, on the opposite asset. And the net of that should be a win. Now, What we want, again, is something like this. We want a spread that crosses the zero line very often. And what we don't want is something that looks like this. This is the spread in z-score for a completely different pair. So things can go very wrong if a pair is co-integrated, but actually the behavior of the spread doesn't really line up to what it is we're looking for. So what we want to do is avoid a bad ending. This is the equity curve of this same bad spread that I just showed you, where we actually lost nearly 80% of our money. So let me just be very clear. It doesn't matter what trading strategy you have, there are risks. You need to know the risks, and you need to understand how to optimize so that everything fits in your favor, like any other trading strategy. And luckily, there's a very objective way of doing that, which is why I love the z-score methodology and the statistical arbitrage pairs trading methodology, because I'm taking a lot of subjectivity out of the equation. Let's just recap. It needs to be a co-integrated pair, and I want the right behavior on the spread, something that looks like it's predictable, that it's done well in the past, and it's likely to continue doing well in the future. Now, we need to caveat that. Just because something behaved a certain way of the past has absolutely no guarantee on how it will behave in the future. Just remember that. But when we're looking at the spread behavior, there's a few things I'm interested in. And one of the wizards at the Crypto Wizards channel, and who uses the platform for trading as well, is a Forex trader. And he said, Sean, you really need to add in half-life. So before, we were using something called the AD Fuller, which looks at stationarity, zero crossings to see how often the spread crosses the zero line. But actually, I found this half-life to be the most useful. And the way you can think of half-life is it essentially says, how long does it take for the spread to revert back to its mean, essentially? So if a half-life was 10, and I'm looking at an hourly chart, that could mean that it might take 10 hours for it to revert back to its mean, because statistical arbitrage is what's known as a mean reverting strategy. And so to find coins or cryptocurrencies or Forex pairs that show a very promising behavior for trading, we care about this half-life or AD Fuller or zero crossings, whatever your methodology is to find those. But at the end of the day, you need to eyeball the result anyway. Look at it with your own eyes. And like we said, if the spread does the up and down sine wave type movement, then this appears to be a much more predictable pair for trading. Now, let's take a look at some metrics so that we can cover what all of these are, because when you're using this on Crypto Wizards, you're going to want to know what do all these numbers mean. It's a bit overwhelming. Well, the first point on the left is coint. Coint just means, is this co-integrated? And then the p-value and the t-value are the measures of how co-integrated it is. So a p-value of 0 means there's not enough decimal places on this. It means that it's like super co-integrated. So Aave and QNT at the time of pulling this data are super co-integrated. The t-check is just, there is a test value that gets compared to a critical value. And this is using a Python library to do that check. And essentially, if the test value compares well to the critical value, then that's another piece of evidence that this is co-integrated. So this is just telling you how co-integrated is this pair. Well, according to the data here, this is extremely strongly co-integrated, right? And then we have the hedge ratio of 1.9. So to buy one QNT, we would need a roughly 1.9 Aave in this example. And then the half-life here, we've got a half-life of 12. Now this is using hourly data, so that means that it takes about 12 hours on average for the spread to revert back to its mean. And that's a very loose way of explaining half-life, but it's very, very useful for identifying a very good spread. And the lower the half-life, in my opinion, the better the prospect potentially is for trading. The Sharpe ratio, so net Sharpe ratio looks at what is the Sharpe ratio of this trading strategy based on a backtest, including no trading commissions, right? So all backtests are really run for directional purposes only, right? Like directionally, is this a good pair or not? Nothing's ever going to beat actually trading or forward testing trading. Backtesting is always very subjective, but at least directionally, it can tell us whether the odds are in our favor or not. So the Sharpe ratio here of 1.1, a very loose way of understanding that again is for every dollar of risk I'm taking, how much return am I getting? And as long as that's over 1.5 or higher is great, then we're doing well. The win rate of the strategy here was 76%, meaning if you look at the count of trades that ended up in a profit compared to the total number of trades, it was 76%. The Z-score negative win rate means the trades that we would have taken if the Z-score was negative, what was their win rate? So going long on the strategy was 83%. And when the Z-score was positive, and actually I need to correct this here in terms of the slide and also showing minus or plus, but if the Z-score was positive, the win rate was only 69%. Now the number of trades opened here were 26 trades, and the number we opened when the Z-score was negative was 13, and the number we opened when it was positive was also 13. And this is all based on the backtest. The net average return was 16%, and over the total period, the strategy with 0 commissions would have returned about 45%. So that's looking very, very promising until we get to the max drawdown. So what is the net max drawdown? And the maximum drawdown you can think of as from a peak to a trough, the widest gap from a peak to a trough, how much did my portfolio drop by? And so it doesn't mean you were in a loss, it just means from where you were at in terms of you could have been doing great, you could have been at a great point in the strategy, how much did you drop by before you recovered again? And that was here 31.3%. So you want your max drawdown to be as low as possible. Now let's compare this to another pair. Here, the same one we looked at earlier in terms of a bad pair. You can see it's not co-integrated. The Sharpe ratio is horrific. It's negative, meaning it made a loss. The hedge ratio is irrelevant really in terms of analyzing this based on profitability. The half-life is negative, meaning that the calculation for half-life just doesn't even work for this, right? It doesn't even work for this asset. A negative half-life is kind of meaningless. I would just ignore it. The net win rate here is 50%, so half my trades worked out okay, and you get the idea. Overall, this strategy had lost 38% on average. If I take the average return, it's 38% loss, and the total return was 83% loss on this strategy because we didn't have a good half-life indicator. They weren't co-integrated. And it also could have been based on where I decided to enter and exit based on the Z-score. Now, let me actually just show you how easy it is to go and find these pairs because we are scanning for these all the time. And if you're trading crypto, we scan 5-minute timeframes, 1-hour timeframes, and daily timeframes. Usually co-integration and statistical arbitrage is more of a daily type of activity. But what I've found, and speaking with other traders as well in the community, is that hourly works really well. And so I've defaulted the tool here to work based on an hourly time frame. And so what I can do here is pick whether I'm doing Forex or crypto. Here I'm going to stick with crypto because that's my comfort zone. I'm not super knowledgeable about Forex trading at all, by the way. But there are people much smarter than me that have helped me to develop this tool and make it better. So instead of filtering on the newest, I could filter based on something like, let's say, the half-life, or sort it based on half-life. So you can see here the half-life goes from low to high. And here I can see this finding here was co-integrated. I can see what time the algorithm had spotted this as a potential trading opportunity. The profile match is a machine learning method we've brought into this, and it's neither good nor bad. It just means that if you look at the returns and the volatility of this pair, they fall within the same cluster, right? They've got similar patterns in terms of returns and volatility to each other. Now the hedge ratio over here is just saying we have a hedge ratio available, and very soon that'll be updated to show the actual hedge ratio that is being run when I click on it, right? So that's very soon going to show here, and we're updating this all the time, right? I'm getting suggestions coming in all the time, requests from traders. This is helpful, please can we add this? There's one Forex trader in particular, you know who you are, who's actually been the reason for a lot of these improvements and new calculations coming in. The Z-score over here is just telling me right now. So if I go to, for example, filter on newest, and I want to trade right now, I could look for something where, say, the Z-score is at here, 2.21. This is like extremely high. This could signal a potential trading opportunity. And this was at 2 minutes past 2 p.m. I'm now at 11 minutes past, right? So this might be an interesting one to analyze and potentially go and trade. Mind you, I don't like the half-life here. I find that, for me personally, that half-life is too high. And so what I might want to do is go and sort this by half-life again and use one of these. Now, when I look at the AD Fuller, this is just a test of stationarity. It's a lot like half-life in the sense of it's giving me an idea of how good the spread is. Now let me go and select, for example, one of these here where the profile matches okay. And you can see I'm just eyeballing this. So this one here looks really good. This is, so this is Quant again versus Aptos. So this is also looking really interesting. It's telling me, you know, what does the price comparison look like? What does the spread look like? What does the Z-score look like? If you hold control, by the way, you can zoom in and out of the charts as well. You can also pan them left and right. I know a lot of people probably don't know that because I've never mentioned it. But if you hold control whilst you're moving or scroll with your fingers, if you're on your mobile phone, you can do all that as well. So that's very useful, but maybe I want to know a bit more, right? Maybe I want to play with the backtest and say, okay, what would happen if I closed when the Z-score was above 2 and opened it when it was at a negative, say 2 standard deviation threshold. And keep an eye on these numbers. You'll see these numbers change. Now, if the half-life is 12, let's for argument's sake say that I go and close the trades only when it reaches a period of 12. And here, watch what happens when I go and do that. So here my win rate drops, but my total return is 54%. Now, if I remove that filter, it was 53% before. And you might find the change is dramatic depending on what pair you're comparing to. What if we just close when things revert to the mean? You can see I actually make 67% return. So what this is saying is, let's say I go long when it's at -2 and the Z-score crosses the 0 mark, that's when I would get out. Or if it was +2 and I went short on the pair and it goes below 0 or hits 0 again, I get out. Then actually in terms of this, my return would have been 67% with a Sharpe of 1.6, which is extremely good. So this is just allowing me to basically on the fly change the backtest to see directionally what might have worked best for this pair. Now let's say I want a bit more detail. I can actually click on this chart icon up here and it'll pull it up for me. Now you can filter on any coins you want, anything that Binance is using, or if you're doing Forex, you can drop it down to Forex. You can filter on whatever you want here, but if you're going from the other view, it will automatically put and assume you want to look at that token. And it'll give me some more information like this equity curve over here. So just to summarize and recap here, when you're looking at statistical arbitrage, there are dangers. The dangers are that the pairs can divert even more. If that happens, you're going to lose money. But to decrease the odds and the risk of that happening, what you're doing is you're looking for pairs that are strongly co-integrated, that show directionally they've performed very well based on a pairs trading strategy like the one I'm showing you over here. They have a good half-life with a decent behavior predictability, I would say, when looking at the spread. And just bear in mind that just because something worked in the past doesn't mean it's going to work in the future. So again, I'm going to call him Mr. X. One of the things that our friend who trades a lot of Forex has said is it would be very useful to have portfolio tracking. So the next thing we're working on now is to go and put in portfolio tracking. When I asked you guys at the channel, 70% of the respondents, just over 70%, said they would no doubt use portfolio tracking. It's very useful. And that's very helpful because it will enable you to take snapshots of actual prices in the live market in a paper trading way, in a more automated fashion, so that you can track how trades would have actually performed and label them with different strategies, so you can see which strategy in a forward testing environment would have worked the best. Anyhow, if you found this very useful, if you found it enlightening, if you found it insightful, go ahead and become a wizard. You can go to cryptowizards.net, feel free to sign up there and support the community, support the cause, where we want to move away from complete BS in terms of trading and more to an objective approach that can actually provide traders with an edge. Until the next one, thanks for watching, take care and talk soon.